In 2023, not only did we see layoffs rise, but we also saw layoffs accelerate. But what most people don't understand about these layoffs is that there's a hidden agenda behind these layoffs. Take a look. Normally, when you hear that a company is doing layoffs, you might think that the company's in trouble, but when Spotify announced that they're going to be laying off 17% of their employees and cut more than 1,000 jobs, their stock price soared because investors were excited about the job cuts. Now, you might think, oh, that's just an outlier. But what we've been seeing happen is that as companies announce layoffs, their stock prices go up. As companies cut jobs, investors buy more of that stock, and that stock and company become more valuable. Now, if you really want to understand what's going on here, there are two things that I want you to understand. You got to start by going back and understand the shifting economy, and number two is you got to understand how employer operations work. So let me start by going back a little bit and talk about how the economy is shifting. If we go back a few years to the pandemic boom, we saw money flowing freely, and this meant that businesses were booming and hiring went nuts across the economy. But then, of course, came 2022. And in 2022, that was when things started to flip because we started to see the impacts of all the money printing through the high inflation. And that was when our central bank, the Federal Reserve Bank, said, we need to stop this and we need to start doing the opposite, which meant they started to turn off this free money printer and they started to raise interest rates in 2022, which started to change the way that our economy started to work, and it started to change the growth in the job market. I'll show you. This is a chart from the Federal Reserve Bank showing wage growth for the last 5 years. And you can see that wage growth from the pandemic onwards was booming. But then in the middle of 2022, you can start to see that flip. Wage growth has been falling ever since. See, higher interest rates have an impact on the economy, and some of these are pretty obvious. Like when interest rates go up, buying a home becomes more expensive because now you have to pay more money in your mortgage, and it also means that buying a car is more expensive, and it also means that putting money in your credit card is more expensive. All of these things slow down spending, which impact the economy. And so now as companies start to see the changing in spending and the changing in the economy, they say, oh, we have been hiring all these people and doing all this economic growth and doing all this growth in our business. I think we need to right size our company. I think we need to be a little bit more productive. I think we need to be a little bit more efficient in our company because we have a lot of employees and not enough things being sold. And again, that's why in 2022, we saw this big shift where companies were really pressing productivity and efficiency and even the return to work. That way companies can drive more revenue for every employee because there was this shift in the economy. And along with the shift in the economy came the shift in the job market because in 2020, 2021, and even into 2022, the power was really in the hands of the employee. You saw employees going through the great resignation and quiet quitting and all that stuff where employees were saying, we're not happy with our work, we're not happy with our pay, we're not happy with our work-life balance, and employees were able to kind of get whatever they wanted. But then 2022 and even more into 2023, the power went back into the hands of the employer. I wouldn't say fully into the hands of the employer, but it started to balance out a little bit more because now employers are being more picky. They're not raising wages the way that they were. They're not hiring as many people as they were before because they don't need to. And we're still really haven't seen this full even out of the balance, but you're starting to see this shift in the job market because of the shift in the economy. So now that we laid the foundation, now that you understand how the economic changes have been impacting the job market changes, let's go even deeper into the employer operations to understand why we've been seeing this shift with layoffs. Now, I do want to let you know that the best way to protect yourself financially is to become financially educated, because when you become financially educated, you learn how to put your money to work, you learn how to invest your money and create new streams of income through your money. We have a free ebook at Briefs Media that walks you through how to do this, that walks you through how to start investing your money, how to start building your wealth, and how to create cash flow from investments. This ebook is completely free. So if you want to get a copy of this ebook, start learning and start putting your money to work, I got the link to how you can download this ebook for free and start learning down in the description below, or you can go to briefs.co/ebook. Now, if we go back to what I talked about in the beginning of this video, which was that companies like Spotify were laying off employees and then the stock price was rallying. What is going on here? And the thing that you have to understand is that there's a couple of different parts to a company, because a company is made up of its employees and then it also has its owners, which can have some overlap, but also has its differences as well, because the employees are the people that work in a company. Right? These are the people that are working in the office. This includes the CEO. This includes the CFO. This includes all the people that are doing the day-to-day work. All these people are employees in the company, and everybody here works not just for the CEO, but also the owners of the company. Who are the owners of a company? Well, the owners of a company, if it's a publicly traded company like Spotify, are people on the stock market. These are investors, regular people, but also institutions, also banks, also hedge funds, people who own a piece of the company. So now you have the people that work in the company, including the CEO. And many times the CEO is also going to have some ownership in the company, but all these people that work in the company, in the office, are the employees in the company, and their job is to do one thing. It's not to make the customers happy. It's not to produce the best product. It's to increase the shareholder value. That is your CEO's fiduciary duty. Their duty is to increase the shareholder value, and so everything that they come up with, their rules, their product decisions, their marketing decisions, are to increase shareholder value. How do you increase shareholder value? Well, that means you're increasing the stock price. How do you increase the stock price? Well, this means now you're going to do things to help boost sales, boost profits, because that's going to make your company a more profitable investment. Because remember, the CEO and the executives are working for the shareholders. So, if a company now is facing changing economic trends, where you're seeing companies not make as much money, maybe advertising revenues are falling, maybe you're seeing changing ways of spending, well, now companies are saying, maybe we need to let go of some divisions, or maybe we need to let go of some unproductive employees, or maybe we can cut 25% of our workforce and still generate the same revenue, because some people are just not putting in the same effort as others. And so we've been seeing this shift happen over the last 12 to 16 months, where more and more companies have been either right-sizing or increasing productivity through their work by letting some people go because, well, you've been seeing a lot of pressure from shareholders, because shareholders are saying, we're not seeing that same economic boom that we're seeing in 2021 and 2022. And if this continues in 2024, well, we have to start projecting today and start changing our expenses today. And so what companies are doing is, well, they want to keep the best work. And one of the reasons why companies are going back into the office is to increase their productivity. But another reason is because they want some employees just to leave. But another reason you've been seeing more and more companies demand employees go back into the office is because they know everybody's not going to come back. And so some people will leave by themselves. And if you leave by yourself, well, you're not going to have to worry about being paid a severance, which saves the company some cost. And who's going to come back into the office? Well, generally, it's the people that are a little bit more dedicated. Maybe the people that are willing to do whatever it takes for the company. So it's almost like a way for the company to weed out the people that aren't willing to give that 110%, because employers generally would rather have somebody who's putting in 110% versus somebody who's putting in 85%. I say generally because there's always exceptions to the rule, but employers generally want the person who's going to do whatever it takes for the company. And so now, as you're seeing this change in the workforce, as you're seeing the change in the economy, as you're seeing a change with interest rates, you're seeing that happen in the job market. And remember, you have the employees in a company, the people that work in the company, and then you have the owners of the company. Sometimes you have an overlap, but the owners are the ones that kind of help dictate the decisions of the company. And if the CEO doesn't abide by those rules, especially if it's a publicly traded company, well, then you can see the CEO get kicked out, and the board then puts in a new CEO who helps follow the rules or follows the instructions given by the shareholders of the company. If you've been looking for a step-by-step plan on how you can build wealth or become a millionaire, you are in a right place, because that's exactly what I'm going to be going over in this video. For those of you that have never seen me before, my name is Jaspreet Singh. I'm the founder of a company called Briefs Media, and my financial education journey kind of started on accident, because growing up, I grew up in a traditional Indian house. My